And of course, we've got the NSE boss, Ashish Kumar Chauhan, sort of bringing in the market opening this morning on this historic occasion. So there you go. We've got the sort of levels on your screen, and of course the bell going off there as well. So that's Ashish Kumar Chauhan and Rahul Joshi bringing in the market open on this historic occasion. So that is really something to sort of look at. Well, the market's open and we're down about 25 points. 24,440 is where we are starting, and you've got a 40-odd point lower start. Bank Nifty is starting about 25 points with a 30-point cut. It's actually absolutely flat, nothing at all. And the Sensex is down about 100 points as well. You've got the IT index, which is starting about 0.65 higher. Advanced decline is kind of, more in favor of declines. But of course, by close yesterday, it was very, very, very poor. 10:1 in favor of decline. So it's more evenly balanced still. And today, of course, is going to be a lot about individual stocks, earnings reactions and otherwise. So let's get to it. Surabhi.
Yeah, straight away when I'm looking at the early casualties, M&M Financial and Shoppers Stop. Remember the loss of 20 crores that Shoppers Stop has posted this quarter. Those are two names that are down straight away. But, the large cap picture is not that bad. Remember, in the pre-open, we were looking at a 100-point cut. Well, it's a 25-point dip right now. If we talk about where the losses are coming in from, it's M&M, Power Grid, Eicher Motors, BEL, there's BPCL, across sectoral lines really. There's some PSU selling going on, some auto selling going on. Lever is not in a good mood ahead of numbers, 1% down there. L&T is lower, SBI is lower. So yeah, a lot of the heavyweights are on the way down. What is offering a bit of a counter, Bajaj Finance's reaction is really, really interesting. The stock was down 1% as we started. But the management is saying that this is probably the worst of the credit quality issues, and this is it. It gets better from here. And maybe the market wants to kind of buy into that. I saw some brokerage reports that still have a 9,000 rupee target on the stock. It seems to be a, keep the faith, buy this dip sort of a moment for Bajaj Finance, and we'll get more analysis on that going as we go forward. Finserv is also up and about 2% higher. That's Bajaj Finserv. Bajaj Auto is up about 0.5%. So a lot of Bajaj names right on top. HDFC Bank continuing its good form from yesterday, so there's more gain there, 0.5% higher. And then some of the IT heavyweights are offering a good counterbalance this morning. TCS, Infosys, Wipro, a lot of these names on the upside. So basically, you've got tech to the rescue, HDFC Bank still fighting, standing tall. And Bajaj Finance is a real good flip in this, in the morning. So the bull and bear tussle goes on. At least on that one stock, the bulls are having their way.
120 seconds into the trading session and we're back in the green. So not such a bad outcome because we started off with a cut-off closure around 100 points and the bulls were like this actually. Now building onto these gains are very, very important. And by the way, this reaction on Bajaj Finance, this is heartening to see. This is something that the bulls is really looking forward to. I'll tell you what, if you can get some kind of a positive surprise in the commentary from HUL, Pidilite, TVS Motors, this market will take it very, very positively because that's something that has been missing. Stocks that are moving around though, the Bajaj group itself is doing well. So auto is up, Finserv as well as finance. So those are the top movers. From the metals pack, NMDC have gone ahead and increased prices by close to around 400 and 600 rupees per ton. The street likes that. The stock was down 6% yesterday. It's bounced back close to around 4% today. GMDC, the numbers are quite good. And, on a lower base, though. So that stock as well has opened up the gain of close to around 2%. Joe, from the recent peak, I think the stock is down close to around 35%, but it's up 4% to kickstart trade. So good going out there. A couple of other big movers. Genesis International, I'm not sure what's happened there, but that one's up more than 10% in today's trading session. So massive move is what we're seeing on that one. And a couple of earnings surprises. So good to see. Max Financial, Amber Enterprises, both of them up 6% apiece. You have Wockhardt as well that's bouncing along. And Olectra Greentech, if I saw that correctly, that stock as well has opened up with solid gains in today's trading session. 24,500 is here. So good to see a 150-point bounce from the lows. And the Nifty Bank, that's the one that's giving you that positive surprise. It's up 0.2%. Yesterday it broke the 20, 50 and 100 DMA. But lovely to see the Nifty Bank building on. Prashant, I think it sets us up for an interesting trading session with the first 3-4 minutes of trade.
Oh, no, absolutely. And, now to build on it, right? I mean, that's the thing. And so we were saying in the morning, right? Once again, we are approaching oversold conditions. Earnings are looking a little better, at least the ones which have come in today. But this is all very relative at the margin. So keep that in mind. But it's good to see some green absolutely on the screen. Mazgaon, I mean, just a few other names, right? It's all news related, mostly news related. Bajaj Finance is number one, volume-led gainer. And you've got Mazgaon Dock, which is up about 2%. So these shipping stocks all sold off aggressively yesterday. Paytm is up back above 700 rupees, so 4.5%. Lots of excitement around Paytm, lots of buzz around this one. News has finally come. Coforge is up about 5%. Amber sold off very sharply yesterday. It's bouncing 7%. Persistent, good set of numbers, outpacing revenue growth. All of the IT companies, 3.5% there. NMDC is up 4%, Max Financial is up 6%, SRF, Garden Reach, Hindustan Zinc, GMDC, these are all in the region of about between 2 and 3% at this point in time. On the downside, Zomato is the biggest volume-led loser. It's down a full 4.5%. And you look at something like a Chennai Petro. Chennai Petro is down 10-11%, and it's got very large volumes in it as well. So 789, 788, 789 on Chennai Petro. When they move big, these standalone refiners, both the CPCL and the other one. M&M Finance is down about 5.5%, so no respite here. Gujarat Fluorochem, news related. Nimesh, of course, that D Street chatter getting confirmed. Stocks down 4%, but again, it's had a fantastic, huge rally recently. And I think Supreme Industries is down another 6% this morning after yesterday's 10% cut. They've lowered their guidance there as well. So that's essentially the things, the lay of the land. We got about a 30-odd point pop, which is 120 points from the opening low, almost immediately when the markets kind of bounce right back out. Let's actually cut across to the proceedings at the NSE, where my colleague from Money Control, Mahalakshmi, is speaking with some experts. Listen in.
In dollar terms. In rupee terms, obviously, it's gone up a lot more. Now, we are the 5th largest, nation in terms of market cap. We were 7th largest about 5 years ago. Cash turnover has gone up from 36,000 crores to about 1,22,000 crores. F&O turnover has gone up from 9,50,000 crores to about 400 lakh crores. Demat accounts have gone up from 3.59 crores to 17.5 crores. Demat account openings per month used to average around 3.5 lakhs. Now it is 40 lakhs. All of these numbers obviously tell us that from any dimension you see, and of course in terms of returns, we have had fantastic returns. Whichever way you see, whether it is turnover, the participation, the kind of volumes we see from outside of top 5 cities, the markets have grown. One easy thing to say is that investors chase returns, stock markets have done well, and therefore there is a lot of appetite. But in your perception, what are the key defining factors that you would attribute to this kind of stupendous rise that we have seen?
No, in a way, as you rightly said, 5 years, I would say 10 years, because that's what, in a way, there was a change in policies, change in a way of doing things in, say, 2014. But if you can take it as 2019 also, when Money Control Pro started. The way I look at it is, why do stock markets work? When you measure the markets from the flow, that is the trading volume that happens, I measure it in a way that how does a market help the society create wealth? The basic purpose of the market, although many of us, or most of us feel that purpose of market is trade and trade incessantly. That is not true. The purpose of the market is actually to do price signaling of assets. That is the philosophical purpose. How we achieve it is different, but what it does is that the assets get created, and today there are 2 ways in modern economy to create wealth in an economy. Channelize savings of an economy into productive capital. One is what we call intermediation, where you go through banks, put money into banks, and then banks on lend. But if the other side doesn't pay back, bank still pays you back, and that's the pretensions, that is the way we think it should happen. But the other side is called disintermediation, where you put money directly into a business. And there you need to have a trust of people who are putting that small little 1,000 rupees sitting in Srinagar, sitting in Jorhat, sitting in Dibrugarh, putting that 1,000 rupees in a company working out of Coimbatore. They are not never going to visit that company, but they have a complete trust in India's parliament, India's judiciary, India's ministries and regulators and stock exchanges, but more importantly, they have trust in India's entrepreneurs. That entrepreneur is going to work hard for your 1,000 rupees, her 1,000 rupees. And for me, that trust is what has got created. Usually, I mean, if you read the economics books on markets, it is very clear that countries with low per capita income cannot have good markets, thriving markets, because poor people don't save, and if they save, they don't trust even their brothers with their money. That's why they put money in gold and all. India is an outlier. With $3,000 per capita income, we have now the fourth largest, you said fifth, because you take Bloomberg data, and Bloomberg after 1998 should have merged Hong Kong into China, at least I did, and rest of the world, but Bloomberg still wants to project that Hong Kong is separate from China. But otherwise, India is fourth largest, and the market capitalization is $5.6 trillion, not $4.8 trillion. But besides that, there is no country in the world with $3,000 per capita income, which is our style of markets. $6,000, no market. $12,000, no market. $24,000, one market is there, whose name is China. When markets go down, government has to go and buy shares. You might have seen recently. In India, have you seen that in last 25 years? So that's why I'm saying this is a market of the people, by the people, for the people, but it is a trust between entrepreneurs and the investors. We all, including you guys, we or anyone else, we are just facilitating that. And that is what all of us need to understand, that it's very difficult to create that trust and very easy to give away that trust, right? So nothing should be done by any one of us who eat out of this, right? We are literally drinking out of the same pond. And anyone poisoning that pond, we'll all be hurt, right? So that is where I think this trust is so beautiful. I always say that over last 75 years, 77 years of independence, what India has achieved is trust in its entrepreneurs. And it's so beautiful that somewhere India has become a trustful nation, right? It's a very, very beautiful thing that has happened.
DP, I want to come to you because you crossed a milestone few months back, 10 lakh crore, and you are perhaps present in every nook and corner of India, should I say? You're distributed everywhere. Tell us some anecdotes, numbers, things that demonstrate the trust that he's talking about. What is your hope? What do you see as an opportunity going forward?
Reaching out to every nook and corner and selling trust rather than selling a product. When our people has the trust in the entrepreneurs of the country, and then channelizing that from the farthest part of the country and bringing it to the investment manager who is doing the complete research and investing every single penny of that person into those stocks. This is something which has happened in a very, very beautiful manner. Today we take pride that especially the hidden, everywhere you talk about Northeast, you talk about Kashmir, which he touched about. We are the market leaders because of the brand, because of the trust. People already had trust in the brand. People have channelized money through that channel into this. And today when we are having more than 1.5 crore SIPs, customers into the market with the ticket size of less than 2,000 crores. Just to give you an example, the small cap fund, which is ours, and we don't take pride that we are giving the highest returns because we choose very, very good companies, has got 2.5 million investors every month coming with the ticket size of less than 2,000 crores. 25 लाख लोग जो हैं जो उसमें पैसा डाल रहे हैं हर महीने, और we are not accepting lump sum money, still we are getting 700 crores every month.
Well, that's $4 billion a month into equity mutual funds. That's essentially what Mr. Singh of SBI Mutual Fund, the country's largest mutual fund, is referring to. And of course, we'll cut back to the proceedings there. There is Samir Arora, as you could see from the visuals. There's Saurabh Mukherjee, and there are other market experts. We'll continue to dip in and out of that event. The big news, of course, is what you can see, that Money Control Pro has got 1 million paying subscribers. It's a historic milestone as far as the news business in this country is concerned. Well, the markets has had a swing, 120-point upswing. Then the market dropped into the red, and now it is up again 20 points, right? Look at that. That's what's happened. Opening low, is sort of up 100 and down 100, and now we're about 12 points in the green. What we'll do is we'll just sort of go back to the proceedings at NSE and listen to Samir Arora in conversation.
NSB and all, our assets were less than what we have in Helios now in less than 10 months. And I can see this thing of trust, you can call it, or because of the things set up by the mutual fund industry over the years to get that confidence and whatever protection that we are in our 11-month history have got maybe investors from more than 300, 400 cities. For us, I can see broadly that, people investing 1,000 rupees after the first 5,000 rupees. We are now about 0.3% of their size.
Yeah.
So we hope that we have much more room to grow than the overall this thing. But it is visible everywhere.
So this time it is
but
for
this
real.
time,
this time the confidence that is built up in equities, the trust that we say. Every time in a bull market, one tends to believe this is real, but ultimately you're disappointed
on
because
that
the
point, if I may say, on that point, I may say, because that is my favorite point, that don't look at last 5 years data of the market to say that this market has done very well. If you look at last 3 years, I'm talking about performance only. You look at last 3 years or 7 years or 9 years or 10 years or 15 years or 20 years, it's the same, which is 15, 16% per annum. Last 5 years distorts it because it looks like 22% and all. You just make it last 7 years for Nifty, for NSE 500, it's all the same. Therefore, I don't think it is out of line. But quickly on this alliance thing, in those days there were less distributors. And so I would go and talk to 500 people, 1,000 people who were end investors.
Right.
So it was more fun, actually, than talking to a distributor who's acting tough with you.
Right. Rashesh, again, building on this point on trust, the retail investors have definitely reposed a lot of trust in the market. One thing that sort of is a bit unnerving, I don't know, maybe that's too intense a word, but one disturbing trend is this promoters selling out, and that's been continuous over the last 3 years at least. Do you see that as a concern? As a skeptic, I would say this is distribution. As an optimist, I would say this is democratization. As a realist, what would you say?
Okay, we'll keep dipping into that conversation and get you sound bites coming out of that event. For the time being, this market has been, starved of any kind of good numbers. And we've got one such number, Coforge. That's the management that's joining in on the show. The company reported a very good set of numbers, a well-rounded performance. Margins declined, but also that was because of a couple of one-off costs. They also witnessed solid organic growth with good order intake. We have Sudhir Singh, the CEO of Coforge, joins us on the show. Well, Sudhir, it's not just your investors, but I think the markets are cheering you today because we have been missing any kind of earnings beats. So very good performance is what you have delivered. But can you keep up this momentum? Give us a couple of numbers. Organically, can we see a double-digit growth for this year? And also, what should the margin band look like? The last quarter was, a couple of D&A and other inorganic related costs were there. But on a steady-state basis, what is the margin band?
Well, if you look at our numbers, the Coforge organic business itself on a sequential basis has grown 6.3% in US dollar terms. And of course, when you look at our aggregate numbers, the firm has grown almost 27% sequentially over the last quarter. So as we look ahead and we look at the next 12-month signed order book, which at this point in time is 40% higher year on year at $1.3 billion US dollars. As we look at the order intake during the current quarter, which was more than $500 million, it was exactly $516 million. As we look at the fact that our large deal pipeline, beyond just the 3 that we've announced in the last quarter, is looking even more robust, we feel very confident that not just the coming quarter, which is quarter 3, but quarters to come should see very robust and sustained growth. And we will continue to deliver that growth as we have over the last 7 years.
Sudhir, hi, morning. So if you could put some sort of, rough numbers to that, so that we can understand on a full year basis, let's talk, FY25, what will the base business, the organic business grow at given the strong commentary, and also what the total sort of growth is going to be given the Cigniti acquisition as well?
We don't offer a formal annual revenue guidance, but as you can see, just the quarterly growth this quarter has been 27%. Next quarter, we expect it, even though it's a seasonally weaker quarter for the IT industry, to be a robust growth quarter again, as should quarter 4 be. So on the whole, this should be, I suspect, a standout year for the firm. The growth should be robust, and it will continue to sustain.
Okay, I think the only niggling issue, not nitpicking, but I think it was something that was pointed out, that for the organic business, the margin dipped a little bit in the second quarter. Can you elaborate on what the reasons are? And I think you've indicated to analysts that there could be some additional ESOP costs in the quarters ahead as well. So if you could throw some light on this.
Absolutely. Our margins at the end of the first half of the current fiscal, our EBITDA is 125 bips higher than last year first half. Quarter 2, the drop that you saw was largely because of the fact that global annual salary increments were done in this quarter. So the quarter in which you do it is the quarter that sees a downward blip. But overall, if you look at the first 6 months, we are 125 bips higher. And we believe that we have significant margin levers even going forward to make sure that we deliver or over-deliver on the margin guidance that we'd given for the year. We had said that our gross margin will go up by 50 bips this year over last year. Given where we stand right now, we believe we're going to meet that guidance and at a stretch exceed that guidance going forward.
But the EBIT level and the ESOP issue that I think was raised in the investor call, can you just tell us can you quantify the impact there?
Sure, the ESOP cost will be the same in BIPS level for the full year as it was last year. We've issued new ESOPs starting quarter 3. Quarter 1 and quarter 2, therefore, saw a depressed ESOP cost. But when you look at the full year, the cost of ESOPs this year is likely to be at the same level as the cost of ESOPs last year.
So, good morning, Prashant here. So, gross margin expansion can be, 75 basis points, 100 basis points?
It's definitely going to be 50 bips that we committed to, Prashant, at the beginning. Currently, where we stand, it's at the end of the first half, it's 60 bips higher than first half last year. If that trajectory sustains, we might land up at 60 or maybe higher. But 50 at a minimum, which is our guidance, is something that we believe is ironclad right now.
You've already given us the headline, a standout year for Coforge. And, it's almost as if, I'm not talking to an IT company, because most IT companies are, when we speak with, still largely the commentary has been slow and we're waiting for things to pick up, etc. But here you're talking about a standout year. So, I mean, we're wrapping up 24. We're looking at calendar 25. Interest rate cuts have started. Does that add to the confidence for calendar 25 as well? I mean, any early indications of budgets, etc.?
Prashant, it does add on the margins to the confidence, but our story, the Coforge growth story, has never really been driven by the demand environment ups and downs. Even last year, which was a very tough year for the industry, we had grown 13% in CC terms at a time when most firms were struggling to get to 3, 4, or 5%. So obviously, the demand environment easing with the interest rate movement that you alluded to will help. But even if it doesn't, we will deliver the numbers that we need to deliver.
Sudhir, throw some color on the Cigniti acquisition. Now that's closed out. How is that contributing? And you also mentioned there would be going to be cross-selling opportunities. So if you could quantify a couple of numbers on that front as well, and synergy benefits.
Absolutely. Cigniti in this quarter has grown sequentially 6.1%. So it's obviously exceptional growth that they've recorded. This was the first quarter in which we had operational control over that firm. Their margin, more interestingly, it's not just been a great revenue quarter for them. The EBITDA margin of Cigniti on a sequential basis has jumped 360 bips to 16.2%. When we announced the Cigniti acquisition, we had indicated that we would expect Cigniti to hit an EBITDA of 16.5% by the fourth quarter of this year. But we now believe that Cigniti is going to exceed 18% EBITDA by fourth quarter of this year. The cross-sell that you talked about is proceeding extremely well. The growth that we've seen in the current quarter of 6.1% sequential has not come because of the cross-sell opportunities that are in play. It's only been one quarter. We expect that impact to start coming in starting quarter 3 and to be fully reflected by quarter 4.
So that explains in part why you were saying this would be an exceptional year for Coforge. But just round it up for us. I mean, where is the confidence coming in from? I think the insurance vertical, as I can see the numbers here, has done really well for you. 8% sequential growth. BFS is growing. But, really, what makes you confident, and what are the sort of demand triggers that you're seeing out there and the clients that you're working with? I think you're executing contracts on the Gen AI side as well. So just some qualitative perspective as well.
Well, qualitatively, the thing that gives me the most confidence is the fact that every industry vertical of Coforge, every geographical unit of Coforge, and every technology unit of Coforge is doing well. To the point that you made, insurance has grown almost 9% sequentially. These are not YOY numbers. These are not annual numbers. These are sequential numbers. Insurance has grown almost 9%. Banking has grown more than 5%. The exact number is 5.2% sequentially. Travel has grown 6.2%. Emerging verticals have grown more than 7%. Now, when you have a firm which has all businesses, whether it's an industry cut, whether it's a geographical cut, whether it's a horizontal technology cut, all of them firing at the same time, you're not reliant on one vector which can go up or down because of an environment change. So a lot of the confidence comes, A, from the broad-based nature of the growth. Second, a lot of the confidence comes from the fact that our next 12-month signed order book is 40, not 14, 40% higher YOY. That number for a firm our size is $1.3 billion. And third, a lot of the confidence also comes from the revenue momentum. The last 7 quarters have been hellish for the IT industry. But if you look at us, 7 quarters back, we became a $1 billion revenue firm. 7 quarters later, of everything that's happened, at the end of this quarter, we're now running as a $1.5 billion firm. So a lot of that confidence, point number 3, comes from the execution that Team Coforge has turned in and is likely to turn out in the future.
Sure.
All right. Listening to you, so a lot of investors would be calling up the brokers now. It's astounding and incredible as well. So it's an achievement and beautifully summarized as well. So thank you very much for joining us. Great to have you with us here, and appreciate your time on CNBC-TV18. So, that's as Sudhir described, a tough 7 months, but Coforge has sort of navigated it quite nice. I mean, very, very nicely. And $1.5 billion firm now. So 7289 is where Coforge is. It's the biggest sort of earnings reaction which has come through. We'll take a quick commercial break here. Devansh Jain of Inox Gujarat Fluorochemical Group will be joining us on their recent business updates. Remember, they've gotten investors in their battery chemicals business. So we talked to Devansh about that and more. Stay with us. Okay, welcome back. The market is volatile and how, right? I mean, I think it's what, 9:45, so 30 minutes worth of trading. And I think we're in our third big swing of the day. up and down and up and down again. We're down about 54, 55 points as things stand right now. So that's markets for you. Well, Gujarat Fluorochemicals is the next company in question. They're in focus as the company's subsidiary GFCL EV is raised 1,000 crores at an equity valuation of 25,000 crore rupees. Remember, Gujarat Fluoro's own market capitalization is about 50,000 crores. So this is a significant fundraise. Now, these funds have been raised from marquee investors, including family offices of some of the largest business groups in the country. Devansh Jain is Executive Director at Inox GFL Group, and he's joining us to take some questions. Devansh, good to have you with us here. Good morning. Prashant this side. Congratulations. It's a significant sort of development for investors in your company and for you as you look forward into this sort of emerging big business line. Give us some details, though, Devansh. So this is a 100% subsidiary of the listed entity in which you've gotten these investors in. 1,000 crores worth has been put in, and the company is now valued at 25,000 crores. So if you can confirm those details and who has put the money in, if you can give us some inkling, because I believe Mr. Sunil Bharti Mittal's family office is one of the investors, and we got some of the other large family offices, corporate family offices also in. So give us a sense.
Good morning, Prashant. Pleasure to be back. This time, not for the wind business, for the chemicals business. It's a nice day. It feels good. It's a new business which we're building out very, very aggressively, very rapidly. GFCL EV is a 100% subsidiary of Gujarat Fluorochemicals, where we are setting up one of the largest integrated battery chemical complexes outside of China. We have raised 1,000 crores. While I will not name the family offices which have invested, what I could certainly give you is these are some of the largest business groups across auto, across FMCG, across cement, across metals. So very, very strong pedigree guys across family offices which have come in. We've diluted close to about 4% of GFCL EV to raise this capital. I don't know how much everyone knows, but to date, we've pumped in close to 1,500 crores of equity into GFCL EV. And we have a large capex plan of almost about 6,000 crores over the next 2 to 3 years. And this capital raise, along with potentially another round, should see us through that along with our internal accruals.
So 6,000 crores capex over the next 2 to 3 years is the plan here. Another round of funding soon, a year out, by when?
Soon. We're talking to a few large private equity investors. We should be doing another round soon. And with that, I think we should be well covered. The aim is to raise about 2,000 crores. 1,000 odd we've raised from family offices. Potentially another 1,000 would be raised. And that, along with the 1,500 which we've already put in as equity, would be good enough to see through the entire business plan without any debt. I mean, as you would be aware, the Inox GFL Group is very debt averse. We don't like debt in any of our businesses. With this raise, along with the incremental raise, basically all the capexes will be funded from the equity and internal accruals. There will be no borrowings whatsoever across the group.
The business, though, just to kind of is you're going to be making batteries, right?
No, so
putting
what
together.
we make is basically three parts, right? We cater to the entire EVV and the ESS ecosystem. So it's battery chemicals, which is basically electrolytes, salts like lithium hexafluorophosphate, and various formulations and additives which go into the battery, along with cathode active material, which is LFP, and high-end fluoropolymers, which are used as binders, which is both PVDF and PTFE. In effect, broadly, the products which we make, depending on the chemistry, constitute about 40% of the battery. And the battery constitutes about 40% of the electric vehicle's cost. So in effect, we control about 12 to 15% of an electric vehicle's supply chain.
Okay. And this would be 6,000 crores, 2 to 3 years, building out what capacity? I mean, if you can give us a sense. I mean, so for example, when we speak with OEMs like Ola, they give us they're building out this gigafactory, right? I mean, they want to be integrated, and they're building out a large capacity over the next few years. So give us a sense of what, and they would be your customers. Who would be the customers here for you? I mean,
I think just to give you a little overview about the EV landscape, we expect the market to move from about 1,100 gigawatt hours to about 5,000 to 6,000 gigawatt hours by 2030. opening up a $300 billion opportunity. I think what's happening is with the Inflation Reduction Act in the US, primarily supply chain, 95% of the battery supply chain was out of China. And with the IRA, you've effectively cut off the entire Chinese supply chain. So effectively, the entire US market is ideally looking for a key supplier. And I think we fit right in. We are early movers. We've got a majority of the plants up and running. We've gone through multiple rounds of approvals. We are currently in sampling and final trials of our products across our commercial plants. And we expect to start commercial supplies from Q4 FY25. Having said that, I think what's also important is outside of China, there are only one or two small players in Korea and Japan, which gives us a very, very large opportunity to build out this business. While I won't specify exact numbers, but I mean, in LFP, for example, we're looking at over 1 lakh of tonnage. In LiPF6, we're looking at almost 30,000 tonnage over the next 3 years.
So Devansh, just to come in over there. So that's the thing that investors, sometimes grapple with, to try and understand specifically what would be the opportunity for an Indian company. And from what you're saying, it looks like obviously you're catering to the international market and domestic. So if you could give us a mix, how much of it will be international, how much domestic, and isn't there some concern about, while of course it's a big theme and it's here to stay, but isn't there some concern about a little bit of a slowdown in demand as well?
Look,
in the near term, that is.
Look, effectively, as I mentioned to you, the global opportunity is expected to play out from about $65-70 billion currently to almost $300 billion over the next 4 to 5 years. Currently, the supply chain is primarily China-driven. And with the Inflation Reduction Act, for example, in the US, it's banned. You can't be with the Chinese. Effective 25 and 26 for various products. That's where we step in. Europe,
but how much of this would you want to target, Devansh? That's the global picture we've got.
Let me just explain this to you. In Europe, what's happening is majority of the OEMs are moving away from the Chinese supply chain. So you don't have IRA, but they need to have an alternate. And I think that's where we fit in. Now, if you look at the size of the market, almost 55% of the market would be the ex-China market. So currently, maybe the total market, the TAM where we would be playing is about 40 billion, moving up to about $150 billion. At peak, we would target about 7% of the global market. So while you look at a slowdown, which is primarily India, India is very, very small in our larger scheme, and India is really going to play out from 26. Majority of the battery plants are getting in shape now. You'll have some capacities coming up next year, be it Ola and so on and so forth. It's too small. We're really playing the global markets at this point in time.
Okay. Hi, Devansh. Congratulations on this, big announcement. And you clearly seem very confident and optimistic about the future. Give us a few quick numbers, though. Out of the 1,000 crores, how much is the promoter entity putting in?
So the promoters have put in 200 crores. The remaining is coming 200, and the remaining is coming from, the larger family offices across India.
Got it. That's out of the way. Next up, what is the ROE you're expecting on this business? Currently, I think it's around 17-18% for GFCL.
Look, we would expect much higher than that, but I would not be able to. Talk about that at this point in time.
Point number 3, will you be looking at listing this business? That should be the eventual plan, say in the next 3-4 years?
Yes, certainly. I think as is known across Inox GFL Group, we build out businesses, capitalize them well, and once they're on their own, we eventually list them. So certainly for GFCL EV as well, we would be listing this over the time period you mentioned.
Okay, in the next 3 to 4 years. And this remaining 1,000 crores that you were talking about, a fundraise, will be done at similar valuations, and should we expect it in this fiscal year?
I would expect so.
Okay. Devan, just sorry, one thing. You said this business is already up and running for you?
So all our plants, so we've got our LiPF6 plant running, we have our electrolytes plant running. In this quarter, we expect to commission our LFP plant. So these are all commercial plants. I mean, it's a very, very rigorous approval process. You'd have a pilot plant, then you have a commercial plant. It takes a year from the pilot plant, then from the commercial plant, another 9 months or so. We've got sampling done, validation going on. As I mentioned, Q4 is when we expect to start commercial sales of most of these products.
So FY27, right? What roughly? I mean, just to give a sense of what we're looking at. What could revenues be?
In excess of $1.5 billion.
From the EV business.
That's right.
Okay, FY27, $1.5 billion in revenues.
On an investment of 6,000 crores.
Well, the investment will play out. So that would be for the larger top line.
Okay.
The turnover ratio we would look at about 2 times, but
2 times.
2 to 2.5 times. But effectively, 6,000 would enable us to supply,
12 to 15,000 crores.
And growing at what rate, Devansh? From there on, you mentioned those numbers. $150 billion TAM. You like a 7% share. So sure, I mean that's a very large.
But that's in 2030. Let's get there.
I know.
I think at this point in time, the TAM is at about 40 billion. We are ramping up. I think, as I said, with the equity raise we're doing at this point in time and the equity we've already pumped in, the internal accruals are large enough to keep growing that business. So, I mean, we're looking at abnormal growth rates for the next 3 to 4 years. And then they would peter down, but I think they would be fairly high even at that point in time.
Got it. All right, Devansh, thanks a lot for joining. Congratulations on this big announcement. We look forward to touching base with you as you raise some more capital and as things progress. Well, time to move on then. It's time for our special segment, Quarter Se Quarter Tak, where we get you earnings expectations from every sector. Vamakshi joins us to tell us how Q2 will shape up for the capital goods sector. Vamakshi.
Well, Q1 was a solid quarter for most industrial product companies with strong commentary on tender and order pipeline. Looking ahead to Q2, domestic order inflow is expected to ramp up now with the election and the budget behind us. Private capex is likely to see selective growth in sectors like data centers and industrial automation. Exports may still continue to be a bit of a mixed story. Exports for companies like Cummins are likely to bottom out, while for sectors such as energy transition, turbines, as well as transmission and distribution, they are likely to be robust. We expect strong double-digit revenue growth. Margins may sustain given the demand dynamics, healthy pricing, and benign commodity prices. However, in some cases, they could moderate a bit sequentially from abnormally high levels that we saw in the first quarter. ABB is expected to post a healthy quarter driven by strong execution in its electrification and motion segments. Revenue is projected to grow by 18.4%. Margins may expand by 262 basis points and net profit is likely to rise by 35.4%. Siemens revenue is expected to grow by 11.9% on a high base with healthy growth in its smart infrastructure, mobility and energy segments. EBITDA margin for the company could come in at 14% with broad-based expansion across segments, and net profit could see an uptick of 27%. For Cummins, this is the first quarter post the transition to the new CBCP 4+ gensets. Macquarie's channel checks suggest relatively better absorption of increased prices. We're expecting exports to recover sequentially and forecasting a nearly 17% growth in its revenue, 22.9% growth in its net profit, and 161 basis points jump in its margins. Thermax is likely to see a growth of 12.4% in its revenue, led by better execution in industrials and products and green solutions, and a rise of 10.6% in its net profit. Margins may expand slightly by 15 basis points, but Macquarie believes that with the receipt of 2 large international orders and a low base, order inflows may rise sharply by almost 75% on a year-on-year basis. For BHEL, we expect 17% growth in its revenues. This will largely be driven by power and industrial segments, while we are expecting negative EBITDA margin of 0.64%. It is still expected to be an improvement of around 700 basis points on a year-on-year basis. Net losses too could narrow to 103 crores. Order intake is expected to be very strong. And lastly, let's talk valuations. Of late, valuations have marginally cooled down from recent highs seen in the first quarter. Interestingly, I also looked at how valuations stacked up in 2015-2016, which is when the BSE Capital Goods Index had peaked earlier. Most companies, with the exception of Thermax and Cummins, are trading below the highest PE seen in the 2015 to 2016 period.
All right, Vamakshi, thank you very much for that. That's really helpful. And yes, in a market that's been correcting, quite aggressively now, a lot of these stocks like ABB and Siemens, they've given up only, between 10 to 15% from the peak, not more than that. So can the earnings match up? Priyankar Biswas, India analyst, industrials, logistics and metals at BNP Paribas is with us now. Priyankar, good to have you on. And that's the real question, right? The market has very tall expectations from these stocks. They've been bid up aggressively, still trading at those multiples of 80 times northwards. What are your key expectations?
Yeah, thanks for having me. So I will just put it in a very slightly different context. So these stocks industrial stocks that we are speaking of traditionally had a 60 to 70 times multiple. But usually what has happened was that the order inflows deliveries has been quite strong. And consequently, the numbers that came up in terms of revenues, margin expansions were far higher than what consensus was building in. So what we see, let's say, as a 60, 70 times multiple in the given scheme of given context, if the number delivery is much stronger, then it would probably be actually lower. So we see that particularly in the T&D space and the power side of things, the order inflows may continue to be very strong. I mean, even going forward into the next year as well. And so the strength may continue to be retained in this particular space, particularly things more aligned to the T&D side of things.
Okay, all right. Hi, Priyankar, and good to see you. When Priyankar, our audience is wondering at these valuations what to buy though. So tell us, what is the best, who's best place, keeping in mind the kind of valuations that is trading? If you could give us two of your top picks.
So of course, in the core infra space, I would pick on L&T at this point. So the reason is, like if you would see that the stock price is somewhere around 3,500, 3,600 levels. And there has been a concern of late that maybe the order inflow guidance may miss. That is what the general concern is. Especially like in 2Q of last year, you had some mega orders coming in from Saudi Aramco and one high-speed rail order. So these are lacking here. But given that this is not an election year, domestic order inflows should come up in the next half. And contrary to expectations, the Saudi tendering has actually been quite robust. It's just that L&T's win rate has come off. So on the core, I will see that the margin, that the core multiples have dropped off significantly for L&T. And that is why we would actually suggest that these stocks actually makes quite a sense. And compared to the capital goods, our stance has been that we should focus more on the hard infra logistics sector side of things. So more something like a JSW infra or an ATSEZ. So that would be our focus areas as well.
That's a really interesting point you raise. Why is that, Priyankar, that you're not looking at the core industrial automation / power equipment companies like ABB and Siemens, and you're looking at hard infra players? Why is that?
So the key reason is, so when I gave you the positive thesis on the T&D themes playing out, so of course this would benefit someone like let's say a CG Power or let's say a Siemens or even a Hitachi. But the point is the valuations, if you see, already kind of captures a lot of the positives. We cannot say exactly the same thing about the logistics space, because the point is, in a growing economy, the logistics space also grows in tandem, maybe sometimes even higher. So a good example would be like if you have, let's say, strong steel consumption demand happening in India, which is even happening today as we speak. So there is this headwind of China spreads and those. So in a sense, the consumption of raw materials that is related to the steel aligned sector, that will still go up. So we would rather play in the real economy side of things. That is why we are proposing that we look at logistics.
Got it. Having said that, just to go back to pure industrials, again, the ABB, Siemens, Cummins and Thermax variety, given the elevated valuations that you flagged off, what is the run rate in terms of earnings growth, top line growth that these companies will have to deliver in order to prevent a big disappointment and a big fall? And out of this lot, which one do you like the most? Where do you think the earnings compounding story can continue the best?
Yes, sure. So as I was mentioning, that the T&D remains our thrust area. So in a case like we have a significant transformer shortage as we speak today, and there would be a very significant amount of high voltage linked ordering in the substation space. So clearly at this point, the names which are there in that space, like a CG Power or a Siemens, and even let's say on the EPC side, a KEC would be benefited. But having said that, the valuations have also run up to a great degree. Where we feel that the valuations are not justified, let's say in sort of a Cummins India, like for example, we had taken out a report previously on that that the discount that it had to something like a Siemens or ABB had shrunk down massively. Given the headwinds, that should not be the case. So it's a relative call, maybe I will have to say. However, if the place deliver, let's say, a 20% plus EBITDA CAGR for the next 3 years, then yes, the valuation still remains justified.
Okay, all right, Priyankar, appreciate you joining in, giving us your quick analysis of the sector and how you see things shape up. L&T, the top pick in the infra space for Priyankar, who's over the last few years got quite a few of these calls spot on. Well, quick check on the markets. It's good to see we are approaching the end of the first hour of trade, and the Nifty has recovered from the day's low. The Nifty Bank is performing as well, and you have a lot of stocks that are moving around. By the way, Biocon, I think there was some negative news flow that was flashing for you on the screen. There appears as a big short covering bounce that's taken place. Now the stock has moved to the high point of the day. So sharp uptick is what we're seeing on that counter as well. Good move. And from the Nifty pack, let's just pull out a few stocks out there. Maruti Suzuki, that was breaking some crucial levels on the downside. I think that's popped up. It was trading in the red. It's moved into the green. Always helps the cause. Coal India as well, another one that's been seeing some selling. That as well has been doing quite well. Well, time to slip into a short break. Up next, Lata will be in conversation with Mr. Nitesh Ranjan, the Executive Director of Union Bank. Stay with us.
Welcome back to Corporate Radar. The stock on the radar at the moment is Union Bank. Union Bank reported subdued loan growth but steady margins. The rise in return on assets and return on equity was encouraging, but slippages were worryingly high. Joining me now to decode the results is Mr. Nitesh Ranjan, the Executive Director of Union Bank. Mr. Ranjan, good morning and thank you very much indeed for joining us. Well, let me start with the worrying part first. The slippage is rising from about 1% to about 2.4%. What accounted for the rise?
Yeah, good morning and thank you for having me here. If you recall, in the first quarter con call, we had said that we have a couple of accounts where we are likely to see the stress in the second quarter or the third quarter. Out of that, one account has actually materialized and it has turned NPA during the current quarter. That is why the delinquency ratio which you are seeing is higher. If you remove that one-off account, then delinquency is actually well below 1%.
Okay, I am assuming it is MTNL, but anyway, I guess you cannot mention names. But can we say this is a one-off? Will your slippage ratio start falling from Q3 and Q4?
Yeah, so let me give the perspective. Last quarter, we had said that we are seeing stress in two accounts, out of which one has now materialized. One still is on the radar. Okay, now if we look at the annual guidance for the slippages for the bank, we have told 11,500 crores for the full year.
Yeah.
As of now, 7,500 crores is the slippage in the first half. Now, if you remove this one-off in Q2, actually the slippage in the bank is around 1,800 crore only. So if I take that run rate, then we are still hopeful that we'll be able to maintain the guided level of 11,500 crores of slippages for the year.
Will you far undershoot it? That would be the hope, will you?
That would be difficult if the other account which I spoke about, that also realizes and turns into NPA.
Okay, okay. What about the recoveries? You all have done 7,300 crores so far compared to a guidance of 16,000. Will you meet that target?
Yeah, recovery for the last 2 years, we have been surpassing our own guidance. And this year also, we are very hopeful to do that. In the half year already, 7,300 crore of recovery is there. And there is a good pool of accounts which we are targeting through various methods. And I'm sure that we'll be able to cross that 16,000 crore of guidance.
Okay. The other encouraging part is the fall in NPA ratios. You have guided for 4% at the end of the year. Will you get there? You are now at 4.36, right?
Yes, we are in that direction. And that is something very, very sure that we'll be able to meet the guidance of 4% gross NPA.
Okay, that's good to hear. But the overall credit cost has risen. Will it stay at 1.1 levels or can it get even more troubling?
So actually, if you look at our guidance we gave in the beginning of the year also, this year's credit cost will be below 1%.
Okay.
And this increase in the credit cost for the quarter is because of the one-off account which has slipped. Barring that, actually, the credit cost on normalized basis is below 1%, which you should be able to maintain.
Okay. Well, you know, when you in the place where you have given up the breakup of your difficult loans, there is a slippage in LC and others. Is that something we should worry about in the slippages?
No, so that one large account, okay, LC is the large corporate division. Yes.
Okay, that is included under LC, is it?
Yes.
Okay. Did you have any trouble with unsecured loans and MFIs? What is the performance?
So our total unsecured loan portfolio is around 12,000 crore, which is around 1.5% of the total loan book and around 7% of the total retail loan book. If you look at the growth, it is almost flat YOY in the unsecured loan. And the delinquency ratio is quite manageable at around 1.45%. Entire unsecured loan gross NPL also, if you look at today, it's below 2% level. So far as MFI is concerned, our exposure is very limited. Hardly, I think, 20% of the loan book is to the MFI and few marquee names only, not many players. And we don't see any stress in our loan book to MFI as of now.
Okay. Let me come to growth. It is a bit troubling that your advances are lower quarter on quarter, 1.6% lower. How do you see the second half growth in loans?
Yeah, I think the quarterly and YTD growth, we should split into RAM and the non-RAM sectors. RAM sector still QOQ also, there is a 5% growth rate aided by the retail, agriculture and MSME. There is a flat growth in the corporate, and as we have been telling that our focus in the bottom line, we don't want to grow just for the top line and sacrifice the bottom line. So there is some kind of sacrifice in the large corporate book we have done where the pricing was very, very kind of challenging for us, and we have sacrificed that. Otherwise, it's okay. 11 to 13% is the guidance for the annual growth rate in advances. And I think the RAM sector should support that. In the festive season, we are seeing very good demand in retail. MSME, since middle of the August, we are seeing good pickup in the sanction and disbursement. And we should be able to reach to our guidance level for advances.
Okay. What would your guidance be for loan growth?
That is 11 to 13%. Okay. We should be anywhere in between the guidance range.
Okay. Okay, that's good to hear. I think your LCR ratio is very healthy, 144%, if I'm not mistaken. Would you maintain it at this level? Would you run it down? And what impact can it have on margins if you brought down your LCR?
I think LCR is a comfortable level. We should also factor in the RBI's draft guideline on the increased runoff factor that will take anywhere between 10 to 12% from the current level of LCR that we are reporting. So which will be around 125 to 130% if I factor in that runoff thing.
Mr. Ranjan, just a few more questions. If you expect the LCR rules perhaps to come in the second half. Do you also expect the higher provisioning on project finance to come? And if that comes in the second half, what may be the impact?
See, I think I have on your channel told earlier also in the guidelines, draft guidelines came that this is a very prudent and forward-looking approach that RBI has proposed. I'm not sure when those guidelines are going to be finalized and in what shape, because different stakeholders, including banks, have given our suggestions. So depending on that, we'll take. But I think if I remember the number, the impact is not very significant.
Okay, all right. Well, let's get back to the markets because as I said earlier, we're doing quite well. The heartening aspect actually is not the Nifty. You pull up the mid-cap index. That got an absolute pounding yesterday. That's pullback and that certainly is up close to around 500 points as we speak, a % gain on the mid-cap index. Mitesh is back with us. Mitesh, what do you make of this bounce? A good shorting opportunity, you would say?
Not right now, Nigel. I think given the fact that we have slipped a lot, I think the bounce back could still play out on the upside and you might see higher levels. And the level which I would watch is the first area is around 24,600 of this spot and then 24,800. So I think 24,600, if it manages to cross to sustain above this level, then I think you might see the pullback play out all the way till about 24,800 odd levels. Give and take a few points, and then from there, if there's weakness, we will want to go into the short side of the positions aggressively.
Okay, all right, and I think we're very close to this 100 DMA right now. So my director will pull that up. The Nifty with the 100 DMA, we almost crossed that mark. So that's another important technical level. Mitesh, want to give us a couple of stock calls?
Nigel, Wipro and IT is doing well today. Wipro is something which I would recommend buying with a stop at 542 for targets of 570. In fact, it's not fallen much in the last few days of decline, and some of the IT names are still making fresh highs. So I think that's where the strength is. So Wipro is something which I would recommend buying for targets of 570, as I said. And the other call which I have is slightly on the negative side. So we'll keep a balance there. Grasim is something which I would want to short with a stop at about 2681 for targets of 2600.
Okay, all right. Thanks a lot, Mitesh, for giving us a call on the index as well as individual trading picks as well. Before we get into that break, let's just pull up the Nifty. We have moved above the 100 DMA, so that's encouraging to see. The Nifty up close to around 80 points, and now that's the mark that I'm talking about. Hopefully, it gets closer to around the 20 DMA. I think for the time being, we'll slip into that short break, come back, we'll shift focus to the commodity space. Stay with us.
Welcome back. Well, let's now shift focus to the commodity markets. Manisha is here with the details and the action as always. Manisha, what's capturing your imagination today?
Well, it's a season of all-time highs, really, when you look at precious metals. So gold is doing that, but silver is doing even better. So with 3% of gains in the overnight markets, we've seen $35 an ounce come in for this one. Slight profit taking, as is always the case. When you see that huge run-up come in, there will be some hands which will go in for some profit taking there. But even with these gains, the kind of levels that we are working with right now, the gold prices are trading at a 12-year highs in the international markets, and the Indian prices have seen 1 lakh rupees in the New York session yesterday, which is an all-time high for the prices. So even as we are looking at 99,700 odd in the futures market, in the spot market, you will add GST to this, you will add making charges to it. So it's basically is a lakh rupee plus when it comes to the physical markets there. When you look at the prices on how they've done in the recent past, well, we have seen prices gain up by 9% in last week, 46% now in this year, and 51% in the matter of last 12 months. So that is what silver has done for you in your portfolio there. Well, the reason that silver prices are surging is, one, there is strong investment demand that you have seen come in for this one. And then apart from that, the record high gold prices, safe haven demand that silver also caters to in some sense have been supportive. There is also a record offtake that we've seen come in from the photovoltaic as an industry. And then it also has been about the mine output, which has continued to be stagnant, supporting prices. I want to talk about the world global deficit, and that is a market which continues to support the prices. So this is going to be a fourth straight year that the global silver markets are into a deficit. Last year was almost at around 184 million ounces of a deficit. This year is even higher at 215 million ounces. So we continue to look at those kind of numbers there. The street also is looking at the industrial demand, which is hitting record highs. This is also going to be a fourth straight year that the industrial demand for silver is going to hit a record highs. The markets do believe that going forward from here, it is going to be further highs that you can see in case of silver. A Citi report that came in yesterday suggests that next 6 to 12 months, you could be looking at silver prices hitting $40 an ounce. There also are reports from UBS, JPM, Goldman Sachs, everybody saying that it is going to be anywhere between $38 to $42 on the higher side that you could see for silver prices in the next year.
Okay, all right. Thanks a lot for that, Manisha. Well, we have Dodla Dairy's numbers that are flashing for you on the screen. 30% growth on the top line. Good performance, it looks like, on the top line. Let's get the profitability number as well. That should come up for you on the screen. The EBITDA number as well is up close to around 36%. So good one on that stock. But let's go across to Nimesh. He's here to tell us about Bajaj Auto. Nimesh?
Hi, Nigel. You know, we heard the management yesterday and they were quite confident. Rajiv Bajaj was quite confident about Q2 and Q3. But Goldman Sachs has today gone ahead and upgraded the stock to a buy from neutral, and they've raised the target price to 12,500. Now, Goldman's upgrade is based on few theses. One, they expect a 17% domestic two-wheeler volume growth visibility in FY25, which is the current year. 55% large addressable market in the three-wheeler business, where they are market leaders. Third, pick up in the export volumes. Fourth, more runway from the current current levels for the two-wheeler cycle. And 5, a good positioning in the 125cc market. So that's the key reason why they believe that Bajaj should do well. On back of all this, Goldman has raised the FY25 and FY26 EPS estimates by up to 40%. So a big earnings upside is what Goldman believes. And hence, after a 20% correction, what we saw recently, an upgrade to a buy now on Bajaj Auto, and targeted price now raised to 12,500.
All right, big one out there. Thanks a lot, Nimesh, for joining in and giving us that top brokerage call that you're tracking. Well, keep an eye out on a few stocks in the broader markets. We have IOB that's moved to the high point of the day. So good move is what we're seeing out there. HFCL as well has now moved higher. It's up close to around 4%. So these are some of the top volume movers. While on the flip side, we have IDFC First Bank that's seeing some selling. So that stock is down close to around 3% as we speak, currently at the low point of the day. Well, I'll tell you what, it's time to wrap up on this edition of Bazaar Morning Call. But you stay with us, because Chartbusters comes up next.